Welcome to another edition of my Money Talks video cast. I'm Jerry Slusiewicz, your host. Just want to update you. It's March 12th, 2010, Friday. The markets, measured by the S&P and Dow Jones Industrial Average, are right near the highs for 2010. Basically, what we saw is we had the market decline from October 2007 to March 2009. We had a sustained run-up from March 2009 with very little pullback into January 2010. From January into February, we had about a 7 to 9% pullback, depending on which indice you looked at. But small, mid, and the NASDAQ have kind of broken out to the upside. The S&P and Dow are right there at the moment of truth. They're retesting the old highs. Now, what can happen? We can have what's called a double top formation and see the market fail in here, or we can see a continued rise in the market to 1200. Probably would be first resistance, maybe 1250. So that's anywhere from 5 to 10% up from here, and certain sectors will do better than others. So we're kind of at what I call the moment of truth. And this moment of truth will probably resolve itself maybe today, maybe in the next few days, but it's interesting to me that most of the economic news is pretty poor. I know the media touts it and spinning it in a very positive light, but when you really read the reports, if you take the time to be a professional and look at everything, things are not as glowing as they seem. We've got a couple of big factors, like for example, the Fed is going to stop buying mortgage securities at the end of March, end of this month. That could lead to higher interest rates. If interest rates start to tick up, in particular on mortgages, real estate could have a second leg down. There's a huge number of foreclosures still coming through. The jobs number, while it was better than expected, it's still not better, okay? Big factor there. Better than expected does not mean better. Although retail sales have improved, consumer seems to be spending money, and the consumer does drive the economy. It's a matter of, are they spending the money with savings, or are they spending it through revolving credit, for example, credit cards, and just building up their debt because they haven't learned their lesson yet. The bias is bullish at this point in time. I've been negative, not that I'm overly positive, but should we break above 1150 on the S&P, which could happen as early as today, it's probably important to become more invested. The retail investor should take some of their assets from the sidelines, from bonds, and put it back into stocks. But use stop losses, use caution, be very, very careful, as this could be a fake, because the volume is not there, which means participation and conviction have not been strong. It's very important to have an exit strategy. It's one of the things I do, Jerry Slusiewicz, president of this company, Pacific Financial Planners. We use an exit strategy on all positions that we invest in, because defense is more important than offense in this kind of environment. I have the updated website. We're putting out the blog on a regular basis. It's not daily, but we're trying to update you on the market at www.yourmoneytalks.com. You can sign up for our free newsletter. If you've got any further questions, you want the free portfolio review, call our office toll-free 800-449-9501. 800-449-9501. I'm not going to ask you to invest a dime. What I'm going to ask you to do is invest 40 minutes of your time to learn how to be a better long-term investor. Thanks for listening.